Started with $1 and a dream. This one for all the people that said I couldn't do it.
Good day, chasers. Thank you for making it up to this lesson. Today we'll be focusing on lesson 6, which will be on trend identification. In trend identification, we'll be looking at the types of trends, how to decide on the existence of a trend, trending markets, retracements, nature, theory, how to identify structure pattern. How to identify structure. Oh yeah, structure pattern also falls. And entry and exit signal. Types of trend. We've got an uptrend, a downtrend, a ranging trend, which is the sideways trend. Now let's look at what we mean when we're saying all of that. In an uptrend, the market rises and makes a sequence of higher highs and higher lows. And you can see there we've got our figure. It shows the market starting from the low. It goes up, creates a high, retraces back, creates a higher low. It's a high. The reason it's a higher low is that it couldn't break the previous low. So it's a higher low. And it goes back up, it breaks the high and creates a new higher high, retraces back, can't break that low, so forms a new higher low, and so on. That's how we spot the uptrend. That's why they say the market rises and makes a sequence of the higher highs and higher lows. And in a downtrend, the market falls and makes a sequence of lower low and lower highs. It came from the top side, from the high, it came down, created a lower low, went back up, couldn't break that high, so it's a lower high. It couldn't break the high, so it's a lower high. Broke the low, it came down, it broke the low, so it formed a new lower low, and so on. That's how we spot the downtrend. And the ranging trend is that in the ranging market, the market moves in a sequence of sideways manner, meaning that we've got our resistance channel at the top and we've got our support channel at the bottom. Meaning that the market doesn't have any clear specific direction. We don't know whether it's going up or it's going down, but then it's still ranging. So if it breaks to the upside, then we know from now that the momentum is upward. We can start looking for buy trades. If it breaks to the downside, we know the momentum is down. We can start looking for short trades. So in a ranging market, depending on the strategies that we employ, there are different strategies that are being employed in the market, meaning that there are strategies for trending markets and strategies for ranging markets. So if your strategy is about trend market, you don't have to trending markets. You're not allowed to be involved in such market conditions. So this is the ranging market. As you can see, there's no clear direction. The market is just going sideways, up and down, not creating highs, not creating lows, just ranging. And to apply trend strategies, we must be aware of the existence of the trend. Without identifying trend, we would be gambling. That's very wise words. Those words are wise. Meaning that to apply trend strategies, we must be aware of the existence of the trend. Meaning that you can't just you can't have a strategy that includes trend, following the trend, but then you enter without knowing whether is it an uptrend or a downtrend. You just see it moving and you want to be involved in the trade because someone entered or something like that. So stuff like that are not good for your trading career. And without a different trend, would be gambling. Yeah, it would be gambling because you'd just be taking guesses instead of taking educational guesses. You just be taking guesses or opinions or stuff like that. So yeah, that's something that we should note down and keep in our trading plan or trading journal. And how do I decide on the existence of a trend? There are many technical tools that can signal the phenomenon, but there are an equal number of false signals generated by them. Remember that there are only 3 types of trends that exist in any time: up, down, and sideways, and it is possible to speak of trends between any 2 points on a price chart. Okay, it makes sense. Beginning of an uptrend. An uptrend has been confirmed by breaking high, meaning that we can see price came here from the low, it went up, it created a high, came down, created a low high. You can see this as a higher low. For us to confidently say that we are now experiencing an uptrend is when price broke this level. It broke the high, meaning that it went and created a new higher high. When it went and created a new higher high, that's when we see that's the beginning of an uptrend. And you can see it came, created a low, went high, came retraced, it broke the high. So what happens here is that to see that this is the beginning of an uptrend is that price keeps on breaking the high instead of breaking the low. Let's look at the downtrend. A downtrend has been confirmed by the breaking the low. Okay, you can see the price came here, it moved down on the support channel, came back up, created a high, came down, but then what did it break? The high or the low? It broke the low, meaning that it went and created a lower low, lower low. And here you can see the same thing. Went high, came back down, created a low, couldn't break the high, but eventually broke the low. So meaning that we're experiencing a downward trend, keeps on breaking lows. If it happens that market trends can be identified visually, why do we use tools? Okay, if it happens that the market, why do we use tools such as trend lines and so on? Even though we can notice the existence, we still need technical tools to trade it, meaning that we need those tools that will be able to show us where the market might possibly um, experience a reversal or a breakout or stuff like that. So tools actually needed. You can't just take trades according to what you just like, according to seeing what the market is doing without having trends and seeing what the market is respecting. You should see if it's respecting such line. If it does respect such line, then we need to take such actions. So tools are actually needed in this trading journey. Okay, trending markets. Trending markets tend to make strong moves in the direction of the trend, followed by periods of consolidation or a counter trend retreats before the next leg in the direction of the trend. You'll notice this pattern happens in almost any trend you can find. Typically, what happens to many traders is that they will make some money during the periods of strong directional trend movement, but then they continue to trade as the market takes a breather from the trend and consolidates. It's these periods when traders give up all gains they made when the market was moving aggressively. What does mean is that you'd be able to see that the market is moving upwards, and fortunately you're able to take a long trade. Then you take a long trade, the market does move in your favor, it shoots all the way up, you get maximum profits, and then you're excited about it, you take the profits, then you sit down and think about it. And when you get back to the markets, now the market is consolidating. The last time, the mindset that you have is that this pair is going up, so I want to buy. Even though the market is consolidating, it's going a bit, it's retracing, going down, going down, going down. Now you don't know, you're getting confused. Should I sell? Should I buy? Or let's say now you take a short trade, you see it going down, you sell. It gives you profit for that short while, and then it goes back up, it shoots in the direction of where it was going. And let's say now you take a long trade, you buy, and it continues to go down, either hit your stop loss or you hold a loss for a longer time period, and then it does eventually shoot in your direction. So you should, instead of just instead of trading these retracements and these consolidation areas, rather wait for the next move, the aggressive move, whereby we'll be able to get maximum profits instead of holding a loss for days. Okay, the next point, you need to learn to identify the different parts of a trend. This will help you avoid over trading during the consolidation period and will give you a better chance at profiting when the market makes strong moves. Nice. Okay. There'll be a chapter, okay, not a chapter, there'll be a topic where we'll be speaking on the nature, which is the impulse and the correction. So this is where you'll learn the different parts of a trend. It's very effective. Very effective. Okay, Jesus. Now let's look at the real-time market. The downtrend of creating lower lows and lower highs. The downtrend of creating lower lows and lower highs. Currently, we're looking at this pair, the CAD Japanese yen, on the 1 hour time frame, and the platform that we're utilizing is TradingView. Okay. Now let's say we notice that we've got a downtrend somewhere here. Here's our point. Here's our second point. There we go. There's our second point. So the reason we call this a downtrend is because you can see that the market, it came down from the low compared to these ones. It created a low, corrected upwards. Okay, let me do something like this. Corrected upwards. It couldn't break this high. Couldn't break this high. So it came down, broke the low, corrected upwards, treated this support. This was support, as you can see, support. It broke it. It now turned into resistance. It treated this as the resistance, and then it broke down impulsive. These are the moves that we want to take part of. These moves. Okay, it broke down, came all the way down, and then it corrected, utilizing this previous support, now turned into resistance, then continued to impulse all the way down. Now this is what we call okay, this is how we identify the downtrend, and this is how we take advantage of the downtrend setups. We can see that the market came down, created a low here. The market came down, it created a low here. It couldn't break its high. Couldn't break it. We have the first point, second, here's the impulse, here's the correction. Now down here, it broke its low. Now it confirmed, meaning that okay, now here's a correction. We don't take part of this. Once it gets out of this phase, we take in, we go in, shorted it, and then we came down. Treated this previous support as now, because we covered this in the support and the resistance level. Previous support as now resistance, previous support as now resistance, and previous support and as now resistance. Yeah, as now resistance. Okay, that's the downtrend example of this. Now let's look at the because you can see that it's forming lower low. Okay, that wasn't draw. Okay, but yeah, but you can see I don't have to write all of that. Lower low, lower high, lower low, lower high, lower low, lower high, and here's our lower low. And to confirm that this is no longer downtrend, is that it broke our lower high. It broke it, meaning that it started forming a new high. Can you see where it ended? And it even broke this trend of ours. It broke this here, so we don't take part of this. It broke this, we don't take part of it. Now we know that the market is more likely to reverse and go up. We know for sure that the market is more likely to reverse and go up. There we go. And you can see it moves in two phases, because here you can see it moved up and now it corrected down. Moved up, you can see it started forming a low, high, higher low. It broke here, higher high, higher low, higher high, and so on. Okay, now okay, sorry about that. We're actually focusing on this one. Now let's look at the uptrend scenario of something like this. The uptrend scenario though. Okay, Jesus. Now let's look at the euro US dollar on the daily time frame. The euro US dollar on the daily time frame. Now we're looking at the uptrend scenario. Let's take a look at this. Here we can see here's a low, here's a high, here's a higher low, here's a higher high, here's a higher low, here's a higher high, here's a higher low. Okay, this couldn't break. Higher high, higher low, higher high. Then it broke here. Let's see, it broke the low here. So meaning that it's starting to experience changes. And as you can see, it started forming this, and it broke the low here. Now this confirmed the change of uptrend, the change of uptrend. So let's do something like this here. Something like that. Okay. We're respecting the uptrend here, and we want to see how that came about. Okay, what happened here is that this is an uptrend. Our high is here, our higher low is here, meaning that the market moved in its high, then it corrected, then it moved, created the new high here, corrected, moved, corrected, it moved, okay, moved here, it corrected, then it moved here. As you can see, what I'm trying to show you guys is that this was a resistance. This was the, okay, let me use the channel. Let me come this. There we go. Let me use the channel. Where can I get the channel, resistance channel? Okay, okay, the horizontal line is okay. Let's do this. There we go. There's our high. There's our next high. There we go. There's our other high. Okay. This wasn't supposed to be here. We never saw this as a high. There we go. And there we go. There we go. These are our highs. And fortunately, this one too, you can see it's a high. Okay. So you can see that the market came and created a higher low here. It broke its high, came up here to create its high, came down here to create a higher low. Now this was a strong uptrend. As you can see that it never came back down to test the previous support, meaning that we can never always wait for it to come back down to test the previous support, but then we can just judge it and see what actually happens when the market corrects, when the market retraces. As soon as the market starts to experience retracements, you can just judge what kind of retracements is that. And as soon as it presents itself, we are able now to see what move is going to happen next. And we wait for that move to happen to be able to take part of it. So as you can see, this happened here. Came, retraced, came down here, the trend line went up. Okay, let me draw this trend line on. It started being something like this. Started by being something like this. There we go. Because it came down, then we'd see this first point, it came down, then we'd possibly take it on this point, would go up with it, would come, take it on this point, go up with it, take it, it would come, it would give us this false breakout. Meaning, when I say false breakout, meaning that it broke out and then it impulsed right away inside, back inside. It impulsed right away back inside. Then that's when we are able to do something that we call evolving with trend line. We move and include it, because even if you do something like this, if we still add it here, it will show that it still respects it, but it doesn't mean that this trend line still stands. We do something that we call evolve, then we just evolve it to the newer one, so we don't get more false breakouts, further false breakouts. And okay, sorry about that. And after it went back up, okay, after it went back up, we evolved, came down, broke, came down, couldn't go all the way down. It broke the resistance. It's now treating resistance as support. Then we wait for this impulsive. It broke up, came down, it tested, it went up, it couldn't break the high. So now we know something's happening here. Something's happening here, but then it broke the low, as you can see, broke the low. So we started experiencing a change in trend. And if you look at it, it broke this trend line too. If you do it like this, it broke it here, and it corrected it all the way down. So you can see that this is a real breakout. This is a real breakout. When a breakout happens, like, it shouldn't break out and then impulse back in. It should just break out and continue to drop. That's a real breakout. Okay, so we saw that the market is creating higher highs and higher lows, meaning there is an uptrend. It confirmed our uptrend, meaning that in this, up until we saw this breakout here, in this whole time, we don't even take cells. We don't take small, short-term cells or something like that. We don't take those. In this time frame here, we're just working on buying. We're just buying. But whenever you see a buy setup, we take because it has a more probability. The momentum is upwards. So you can't go down when the momentum is upwards. That would be gambling. You don't know the sentiment of the trade. That would be gambling. Okay. So now we saw the uptrend. Now let's move at the nature of the real-time market, the market trends. Okay, what happened here is that we see that we, on this left side we're experiencing an uptrend. The reason we say it's an uptrend is that it came, here's a low, it went up, it formed a high, came down, couldn't break the low, went up and broke the high, came down, it retraced. As you know, in the previous chapter we spoke of resistance turning into support. So you can see here, this was the resistance. Now it turned into support. Went up, it broke the high, retraced all the way down, and the resistance too turned into support. We see the uptrend keeps on turning resistance into support, the resistance turning into support. And then eventually it went up, created a high, came down to test on that same support. That this time the resistance never turned into support. Came down, test on the same support. It went up, couldn't break the high, and it broke the low, and now we see the support. This was support turns into resistance, and you see it broke low and support turns into resistance and went to go create low. Now this is we see this is what confirms our downtrend, this is what confirms our uptrend, and this is our reversal. But then we'll be speaking of reversal patterns in the next chapters. So speaking of reversal in the next chapters. Retracement. I believe you guys kept on hearing me say retracement, even though I'm not sure if you guys are familiar with the word. So let's just take a look at what this means. These retraces are when we have the highest potential for a high probability entry within the trend. Often, a market will retrace to approximately the level of its previous swing point before the trend resumes. In an uptrend, the swing points are support, and in a downtrend, the swing points are resistance. Look at the very first diagram in this article to refresh what I'm talking about. Also look at the chart. The chart looked at, but this time with support levels marked. The support levels resulted after the market began to retrace lower within the structure of the broader uptrend. Okay, we understand what the retracement is like. It's when the market takes a breather. Let's take a look at this. More words on the retracement. The market will typically retrace back to the previous swing point area and then bounce higher, resuming the trend. These are points where we want to look for price action setups, meaning that price here, okay, this is an uptrend in the scenario. Price came from the low, it went up high, created a higher low, broke the resistance, turned into support. And now when it was on the support, treating this resistance as support, this part here is a retracement of an uptrend. An uptrend retraces going downwards, and the downtrend retraces going upwards, basically. So it's like, it retraced, and you can see. So when it gets to this point, we know for sure that this pair or this price action should go up, but we can't just take guesses without any signals that show us that it should go up. So we need more confirmations of us being able to take the trade. We need more confirmations, which will cover them. And this is where we'll get our setups. You don't enter price when it's just around here or here or anything like that. We enter when it's on these key areas. That's when we look for our confirmations. Okay, NB price. One of the first rules of trend following is that price is I made a mistake. Sorry about that. One of the first rules of trend following is that price is the main concern. A trader needs to only be worried about what the market is doing, not what the market might do. The current price and only the price tells you what the market is doing. Meaning that instead of us having a support level and believing that when it gets here, it's gonna automatically buy. Like that's not that's not a valid strategy that we can be utilizing. In other words, instead of doing that, we can see how the market reacts when it gets. We know that for sure when the market gets on support, it should go back up. This should support it and go back up. But we shouldn't just take a buy once it touches support, because it might be a breakout to the downside. So instead, we should see what setup is being printed there. We should see the signals that the market is giving us. Is it giving us a sell signal or a buy signal? Meaning, if it printed a candlestick that shows that the momentum is going upward, then we know we've got a signal. If it printed a price pattern that shows that it's a reversal, it's going up, or something like that, we believe now we can see that it's going up. We are able to take the trade instead of just taking the trade because it's on support. Okay, now let's look at the nature theory. Nature is the name we give to price action. Fundamentally, price action can either have impulsive nature or corrective nature, and this is therefore what forms the foundation of what the theory of nature is built on. Many traders who have previously used the styles of technical analysis have often explained the difference between understanding nature and market structure to the other common trading styles, like seeing the market in the 2D perspective to gaining a new level of depth leading to a 3D perspective of the market. Being able to simply identify the price action, being able to simply identify the price patterns without truly understanding what type of price action is making up those patterns leads to not understanding the true direction of price. And so we believe that the nature of price action is always the most important part of our direction creation. How do we use the nature theory? The first point, always look at the characteristics of price action. Are we impulsing or correcting? The market is made up of impulsive phases and corrective phases. We'll cover that on the next page. And the second point, understanding how to identify the nature. We are able to become higher level traders. Traders need to understand the nature of the traders need to understand the nature of how price moves into these areas to successfully capitalize on potential moves, rather than taking a trade simply because you have identified a specific pattern. Okay, meaning that knowing the nature, whether this is in the trade is in a corrective phase or impulsive phase, will lead us to a whole new level of trading, instead of just knowing that when it gets to support, I should just buy. Instead of having one confirmation or a few confirmation, but then knowing the phases is what matters most. And I believe that too. The lesson being, we must always focus on the nature of price action. We must ask ourselves what the nature is telling us. Example, price is moving impulsively towards a key area and then stalls for a number of hours. Nature of the market is telling us that the reversal is likely to not happen as we got impulsive price action. A correction now would simply act as a continuation via any of the continuation pattern formation, rather than price rejecting the double top to reverse, which is what it will look like to the average trader who does not look at the nature. I believe that was heard. It doesn't matter if price breaks the areas we are looking at, as long as it is still corrective by nature. If corrective nature was forming, we would normally see the corrective nature take the formation of an ascending reversal pattern, or such as a rising wedge or a rising channel. Okay, this I have to show you guys an example of it. What it means is that if it happens that, okay, let me just use this page. Price is moving upwards like this, upwards, and on this area, let me have a channel around this area. On this area, we've got a channel. We've got a channel on this area. Okay, sorry about that. I want to move this. Okay. We've got a channel on this area, and then something like this happens. Something like this happens. Now, to the average trader, they might be thinking that this is a breakout just because it closed above here. But to others, we might be seeing this as a reversal pattern, meaning that we can see this printing something like this. Something like this. Meaning that we're expecting a drop like, even though it's above the channel, we're expecting a drop like this. That's what the nature is all about. That's what the nature is all about. But we'll focus more on it in the next topics and chapters. Okay, price structure. To understand the structure, we must first understand that the market has a continuous cycle that is ever present. We call this the breathing cycle of the market, a series of consecutive corrections and impulses in a 1, 2, 3 formation. Each cycle is identified as either the corrective phase or the impulsive phase. Meaning that we know that the market moves in 1, 2, 3 formations or phases. The impulsion, if it's a downtrend, it'll impulse all the way down. It'll correct, meaning that it'll consolidate or it'll retrace, and then it'll impulse again. Further, it's down to create lower lows. That's how the market moves. So knowing the phases that you're in, if you know that you're in an impulsive phase, you know you can't enter here because you might more likely to be taken out. If you enter here, that means your stops are gonna be way too far and your risk reward won't even be it won't be a good trade. But then if you enter on once the correction phase is done, enter into the impulse. Let's say you enter somewhere here, enter into the beginning of the impulsive phase, you know that your stops would be somewhere above the corrective phase, and then you expecting a further drop up until the market presents another correction and goes all the way down. Okay, Jesus, as we know that the market moves in a 1, 2, 3 formation, 1, 2, 3 formation, which is the impulse, the correction, and the impulse. So now we'll be able to spot that. We'll be able to spot that when you know what phase we are in, and we shouldn't trade. We shouldn't trade, or according to what the lesson that we've been going through has said, we shouldn't trade a corrective phase. Okay, now let's look at this pair, for instance, the USD CAD, US dollar, the dollar Canadian. The daily time frame. Okay, in the lesson it says something like, okay, let's say this is the drop, something like this, a correction, which is 1, this is the 2, the correction, and the drop, which is the impulse. So now I want to take part of these impulses. Okay, now let's look at this. It came down from here, it impulsed all the way down. We wouldn't be able to take the run, we wouldn't see it because we just came from this uptrend, broke the lows and everything, came back down, it started correcting. Now with this correction, we look at what type of pattern is being formed here. And then we drop the pattern. In this manner, this was a flag. This was a bear flag, even not just a flag, but a bear flag, meaning that it breaks to the downside. So we know what steps to take next. And as soon as this move presented itself, we're involved in a short trade, meaning that all these days here, we don't trade this pair because there's a corrective phase. If you take a long here, it's going to go up, give you a bit of profit, come down, hit your stop loss. If you take a short here, it's going to go up, hit your stop loss, come down, and just like that, will just play around with you. There's no movement. It's not going up, it's not going down, unless you're trading those short time frames, meaning your 15 minutes and stuff like that. But now since we capturing a lot of pips, we don't aim to capture 50 pips or something like that. We capitalizing on 150 pips and above. So these kind of drops are what makes our accounts, because it gives us the advantage of having a minimum stop loss and having a 30 pip stop loss and having take profits of up to 250. So okay, once it breaks here, this is the impulsive. So okay, here's the 1, 2, 3. The 1, the 2, which is the corrective phase, the 3, which is the impulsive phase. And now we are in the Okay, or if it's 1, 2, 3, if you look at it in this manner, it will be 1, 2, 3. We're in the corrective phase, meaning that once we can see that this is a correction, impulsive, correction, impulsive, and now it's a correction, then an impulsive, meaning that if this does respect our pattern that it is printed, because as you can see, I had it's sort of like a rising wedge on this pair. If it does respect it, doesn't matter how it broke here, unless if it corrects in a flag that shows that we're going up, then we know for sure that no, we're still going up here. There's a change of trend. But if it does come down, impulse all the way down, we know, and once it breaks, I'll only start taking shots once it breaks this here, the support of this trend. This one here. I'll only take the support of the pattern, I meant. I'll only take shots here. Once it breaks, I know it's coming all the way down. It's gonna break these lows. It's gonna break these lows. So let's look at how many pips we're talking. Let's say from here up until the lows, this is the low, up until the low, we're able to capitalize 739 pips. 739 pips. There are 739, only this movement. And you see how impulsive this is. You don't have to wait for forever just to let this happen. And let's say once it breaks somewhere here, let's see here, and capitalizing up until the low. Okay. 750, 760, somewhere there. So you can still capitalize 760 pips. And yeah, and it doesn't necessarily mean that you're going to hold the whole 750. It means that it's possible to hold it, because since it's an impulsive drop, it won't take forever to get there. It can take maybe a month. It won't take forever to get there. But what can happen too is that you can find, like in the 750 pips, you can be able to capture 600 pips, meaning that you can find those setups that give you 250 pips, find the other one that will give you 300 pips, find the other one that will give you 150 pips. Then you're okay, you ate from it, then you sort it. So now that is how the market moves in 1, 2, 3 formations: impulse, correction, impulse, and okay, impulse, correction, the impulse. And yeah, we should just be on the lookout for that. We'll talk more in it. We'll talk more about it in the next chapter. Thank you so much for watching. Okay, how to identify structure. The first point of call to be able to judge sentiment is to draw in the framework to be able to actually interpret the data. We do this by drawing the market firstly with a top-down approach, drawing from the monthly time frame to the 1 hour time frame. The way we draw in structure is by simply identifying larger outer structures, identifying trend using the weekly time frame. We identify our trends using the weekly time frame, identifying impulsive and corrective phases using the daily time frame, identifying price patterns using 4-hour time frames, refining the 4-hour and using the 1-hour time frame. And we also utilize the 1-hour time frame to execute our trades. Should take note of that. So on the weekly time frame, we identify the trend. Are we going up or are we going down? Then we note it down. And then on the daily time frame, we identify the impulsive or corrective phases. Are we currently in the impulsive phase or in the correction phase? If we're in the impulsive phase, is down or is it up? And if it's a correction phase, what pattern is it printing out? And I'm gonna where am I gonna be? Where is it gonna give me an opportunity to be involved in one? Because if you just enter on a corrective phase, you are more likely to it's either you're scalping. If you're not scalping, then your trades will just continue to hit stops, because it'll go up, go down, hit your stop, go down, go up, just like they play around with you. And okay, that's the daily. And now identifying price patterns 4-hour, identifying price patterns. You see if it does break this pattern on the 4-hour, I believe that for the whole 200 pips, it's going to continue to go up or it's going to continue to go down. That's identify price patterns. And refining the 4-hour using the 1 hour, meaning that the pattern that you'd be able to spot on the 4 hour. If you move down to a shorter time frame, like your 1 hour, it'll be much more visible. It'll be much more visible. That's why we enter on the 1 hour time frame. 1 hour time frame. Because this is what actually happens. Like from the weekly time frame, you start with weekly and then you move to daily and you draw down each and every pattern that you couldn't see in weekly. Then you drop down to 4 hour, drop down each and every pattern that you couldn't see in daily, drop down to 1 hour, to each and every pattern that you couldn't see in 4 hour, and then that's where you take your trades. That's where you take your trades. Some questions that we ask ourselves to judge our trend lines and gain a belief are: what is the nature telling us? What nature? What are we experiencing? What nature is it telling us? And are we impulsing or correcting? Are we in impulsive phase or corrective phase? Are we correcting and in the corrective? What are we? If we are correcting and in the corrective phase, are we forming a continuation or reversal pattern? Oh yeah. If we are correcting and in a corrective phase, are we forming a continuation pattern or reversal pattern? And that will allow us to come with the conclusion in our direction of that given pair. Now we've got an entry signal and exit signal, meaning that this is what leads us to be able to enter and exit a trade. Okay, let's see. This is the example of an uptrend, and we'll look at the downtrend in the next one. Okay, the entry signal. Enter longs only when the market is moving in higher highs and higher lows. Exit signal. Exit long trades when the market started to form lower highs and lower lows, meaning that when the market is reversing. When the market is reversing. Okay, let's look at this part. Once we find a potential setup on this key area, we enter and put our stops a few pips below and put our target at the highest high, knowing that it will break that point to create a new higher high. Meaning that, okay, we are able to spot that the market moved from low, created high, low, it couldn't break that low, so it's higher low, it went up, broke the high, we know that when it's an uptrend, it continues to break the high, broke the high here, from the new higher high, it came down, treated the resistance as support, and now it gave us, let's say we found a potential setup here that we're going up, we are going up, meaning that here, once the setup is presented and we're confirmed to take a trade, and we see that instead of just predicting that it's going up, we are able to see we'll enter somewhere around here. Instead of just entering exactly, we enter somewhere around here. Then our stop loss would be a few pips below, knowing that if it does break here, if it does break this support, it's now being treated as support. If it does break this, that means it will continue to go down and treat it as resistance and then go all the way down. So our analysis would be incorrect. So our targets would be here on the high, believing that it will break this point, it'll break this point and go and create new higher highs. We can't put it somewhere here because we don't know where it would retrace. We might put it here and then the market just retraces here and even forms a reverse and then goes all the way down. Then we miss out on the profits gained. So we put on highs, being guaranteed that if it is a thing, an uptrend, it will break that high. It will definitely break it. And now entry signal, we're now looking at the downtrend scenario. Enter signal, enter shorts when the market is moving in lower highs and lower lows. Exit signal, exit shorts when the market is forming higher highs and higher lows, meaning that when it starts to reverse, we can see the market came from a high, it created a low, lower high, couldn't break the high, so it's a lower high, broke the low, so now you can see we're in a downtrend, broke the low, this is the support, it now came back, retraced, it formed it treated this part as resistance, treated this part as, we've got our first confirmation would be this trend line. We can see here's our first point, here's our third point, it's on the here's our first point, our second point, it's on the third point, and support is now being treated as, so we have 2 points already, 2 confirmations that this is going down, 2 confirmations, even though we're going to gain more as the lessons continue. And then we enter here, our stop loss below, believing that if it breaks, this is going to go and come back, treat it as support and then go all the way up. And it's gonna, we we notice that it's a downtrend, so it continues to break, it continues to form lower lows, meaning that it's going to break this low to form a new lower low, and it is all the way up. Thank you for watching. I believe that you guys will have a phenomenal day and a productive week. Thank you.